Good morning, everybody, or good evening, depending on which part of the world you're in. But it's 8 a.m. here in Singapore, so welcome to our latest quarterly review in terms of what's happening in the Australian residential property market, and also particularly a focus on what's happening in the finance arena and how that impacts Australian expats all around the world. So for many people who have joined us, you've seen these before, but it's interesting how all the new information that comes out actually makes this a pleasure to prepare data-wise, but also to make sure that people know about these things and share this with everyone. We all know the disclaimer is very important. This is general information. It's not intended as personal advice. And if anyone does need personal advice, then we're more than happy to provide that if you want to reach out on a personal basis. So just a little bit of background for the people that are there that don't know us in terms of history and where we've come from. I founded the Unicorp group some 34 years ago, and initially that was designed as an advisory business for people who were my peers, so other young doctors. And then that grew into the other professions, into the commercial side of the world, mainly in banking and finance. And we developed a Aussie expat clientele by default over the years, and then started our international consulting business, which is Wise Guru, which deals specifically with Australian expats around the world, although now deals with people of many nationalities who have an interest to perhaps buy an asset, a real property asset in Australia. So it's delved out into or moved out into other areas. We have Aussie Property Guru, which is the Australian real estate business, and Aussie Loan Guru is our lending business. That's again a niche business for professionals, for medicos and lawyers, accountants, and for Aussie expats. So that gives us that part, and Unicorp Partners is actually the advisory business that was the initial business developed in Australia and now exists and services our client base in Australia, plus a lot of expats who are looking to gain information about repatriation or their other assets whilst they're away offshore. In general terms, all of our client base has very similar demographics, so we're all very time poor. They earned higher incomes, and they were looking for someone who could provide them with, a solid way of obtaining information so they could make better informed choices. And most of our clients would like to include real property as part of their overall asset portfolio, along with mark-to-market listed assets, etc. So that's where we've come from. There are separate businesses that people can actually seek to get help from, or just specifically in one area if they have a need in that area. And Wise Guru, our consulting business, assists expats all around the world in relation to their property purchasing needs, and we provide a concierge service, which basically is a hand-holding service that assists in all the different facets of property purchasing. And we charge $4,950 for that at settlement of a property if somebody requires a full concierge service. So without further ado, let's have a look at what most people are asking us. And here are some of the most common questions that we're being asked at the moment. Right on everyone's, I suppose, forefront of mind is how much will the RBA raise interest rates? Because we're constantly seeing things about inflation in all the news headlines, and people are asking us, well, how's inflation going to impact my investment property and my rental income? Because I know my expenses are going to go up. So then the flip side of that is they're asking, how will these rising interest rates impact my property value? Because we're seeing, again, a lot of news out about how the increase in interest rates, in official cash rates, is going to provide a significant headwind for most assets, but particularly in Australia, they're focusing on property. Another one of the major considerations is demand. So is population growth returning? now that the borders are open. And then we look at the other area where many large corporates, employers have said that their staff can work from home either on a hybrid or ongoing basis indefinitely. So what impact is that going to have, or what opportunities does that provide potentially? And then last but not least, how can you navigate your way through the current offering in both fixed and variable interest rates and try and take advantage of those situations where possible? So let's have a look at the big one these days is inflation. Inflation expectations, real headline inflation, rises in core inflation, and they're caused by many different things, as we all know. So very tight labour market in the US, in Australia, and that's causing inflation because companies, employers are having to pay their staff more. There was this burst of post-COVID pent-up demand where during COVID people were spending money on goods, online shopping, and now it's on services, so travelling, F&B, etc. And one of the issues, of course, that's arisen is the supply bottlenecks. So we can't get the goods in. And even with services, there are lots of bottlenecks, which I'll come to afterwards. Now, China has maintained its COVID zero policy, which we all have different thoughts about, but that's caused a major dislocation in terms of these supply chain bottlenecks. And of course, lastly, very importantly, the war in Ukraine, how that's impacted commodity flows and also agricultural supply. So lots of different things there causing lots of problems, and therefore central banks are now trying to get ahead of this and tighten monetary policy. Many would say that the Fed has probably left this a little too late, and I'm one of those. I think they should have acted earlier, but if we look at 10-year bond yields and 3-year bond yields and virtually every other instrument, we've seen this massive rise in yields, and that's actually sort of seems to have plateaued in the last 2 weeks. I thought the markets were potentially getting a little ahead of themselves. I still think that, but it has had an impact, as we know, on particularly risk assets. So if we look at equities, for example, very high PE stocks, technology stocks have suffered the brunt of the sell downs of that. We only need to look at the NASDAQ and other indices to see that. So with all of that as a backdrop, we know that Australia is a very large country, and research, which we've always told our clients and our viewers, is very important. It's massively important these days, not just because it is so large and there are so many markets around Australia, but there are so many of these other factors we need to bear in mind. So we use all of the national research organisations, the ABS, Australian Bureau of Statistics, CoreLogic, Urbis, Resolution Research, Oxford Economics, just to mention a few. But we find we need to have our own pragmatic overlay on all this data, because otherwise it's just becomes sometimes a little meaningless. So what's the outlook for the rest of the year? Well, this is the March review. However, we need to be up to the minute, and we all know that the Reserve Bank of Australia raised the official cash rate for the first time beginning of May, and it raised by 25 basis points, which was actually what we thought they should do at the time, as the federal election was looming, and they needed to start that tightening cycle to make people realise that they were going to react. I think that the RBA is in a reasonably good position, especially compared to the Fed in the US, and I think they should be able to navigate this in a far better way overall. So if we look at what's happening in this normalising cycle, the Fed said they're going to do back-to-back 50 basis point increases over the next 2 or 3, 4 meetings. The RBA hasn't come out with any number as such, but they said they'll do what they need to do, and I think they will actually be able to pause towards the end of the year and see the impact of what the increases to the official cash rate have been before they decide on their future path. So let's have a look at this. I think it will expand on a monthly basis, but I think that the Australian official cash rate will probably be somewhere around 125 basis points, 1.25% by the end of the year. So if we look at what's happening though in the fixed interest rate market, and we've been saying this to clients since last year, where we've had some really inexpensive fixed rates being offered by the banks over the last couple of years, and that was mainly due to what the RBA was able to achieve during the pandemic, and have told people if they're going to keep loans for the longer term, which are supporting some of their assets, then they should fix those interest rates. And I think that's been a very good outcome for most people who have done so. So at the moment, obviously, official cash rate at 35 basis points, variable rates are still very low in Australia, but they will continue to rise. So the fixed rates moved up, as we've already said, and there is a differential, as most people know, between owner-occupier interest rates and investor interest rates, where the investor ones are generally higher. Although there's been an interesting new development in the Australian finance market, where for owner-occupiers, if you're looking to finance that on an interest-only basis, it's actually higher than the interest-only rate for investors. I can tell anyone who's interested why that's so. So here's the Westpac predictions, if you like, about what's going to happen over the upcoming year and next year. And Bill Evans, a senior economist there, saying that the RBA will raise rates by 40 basis points at the next meeting in June. I think that we'll potentially see another 25 basis point hike like the last one, although I would say that a 40 basis point hike is actually more beneficial, because I think central banks need to front end load these increases in the official cash rate to get ahead of the inflation surges that we're seeing. And I think that will have an impact, especially in an economy like the Australian one, where you do have very high debt levels. So they're more sensitive to increases in the cash rate. This is the Westpac one, as you can see. They're saying 75 basis points with a cash rate in a week or so's time, and then another 50 basis points by September, and another 50 by the end of the year. So they're looking at 1.75 by the end of the year. But then, as you can see, a very modest increase over 2023, and leaving it there for now. Again, this does change depending on the data that comes in, but it's something worth bearing in mind. The other interesting scenario there is if you look at the differential between the Australian and the US 10-year bonds, as you can see, that's coming down to eventually settle at basically 20 basis points. Now, Australian expats and Australians living in Australia, the weakness or strength in the Australian dollar plays a major part in decision making, and pardon me, currently the Aussie dollar today is close to 71 US cents. Again, Westpac's prediction is that will rise up until the end of 2023 and end up at around 80 cents against the US. If we look at where commodity prices are now, last time commodity prices were where they are now, the Aussie dollar was way above parity against the US dollar. So the fundamentals favour the Australian dollar strength. However, I think it's worth bearing in mind that this time I believe the US Fed is going to have to raise rates more quickly and far more aggressively than the RBA. So that will strengthen the US dollar. And we'll look at that in a basket of currencies, obviously, depending on where people live, what currency they get paid in, etc. So we'll go through all of that and give you some more indications. So, pardon me. If we look at what's happening in inflation in Australia, latest figures, most of the increases are due to fuel prices, housing costs, so costs of housing and rental, and food prices. Now, as we know, with inflation, you've got tradable goods, which are sort of more the global factors, and non-tradables, which are related to wage growth and domestic factors. Regardless of what you look at, I mean, they've reached a 9-year high. If you look at what happened with headline inflation in Australia, take out the speed bump when GST was introduced, it goes back to the early 90s. On the right of your screen there, you'll see what Westpac are thinking in relation to headline and trend mean inflation or core inflation. They could sort of see that, pardon me, peaking in the second half of this year and then actually coming down. Now that would mean that the RBA has been pretty successful in the way they're utilising monetary policy to bring inflation back towards their target band, and would end up being what they call a soft landing. Obviously a good outcome for the economy, a good outcome for Australians. So we'll see what happens, but let's have a look at now population growth, another very important factor. How's Australia's future population going to cope with this 2-year hiatus in net overseas migration? And as we can see by this, actually pretty well. So, the borders opened in February, and already we've seen this quite significant increase in short-term visa holders, overseas students particularly, entering Australia. And it's led to an overall increase here where the government was predicting still a negative growth for net overseas migration. And that would mean, I would suggest, that this will also occur next year in the 22-23 year, and we may see net overseas migration actually getting back to pre-COVID figures, which were around 1.5% per annum, as opposed to the projections of 1.3%, because the prior government quite rightly suggested that we need to, I guess, turbocharge bringing in skilled labour and unskilled labour into Australia, because we have these supply bottlenecks caused by lack of staff. So that will also help in the battle against inflation, and we haven't yet seen skilled migration levels increasing significantly, but I think that might come potentially in the second half of this year or the first half of 23. So we'll keep an eye on that. Pretty important impact, and I think it's heading in the right direction. So we look at the other areas, because people often say to me, "Oh, look, what about macro-prudential levels? What's APRA going to do in relation to housing prices, basically affordability, etc., and demand?" And the RBA and APRA are certainly watching how credit growth goes. It's oscillating quite a bit on a month-by-month basis at the moment. As you can see there, lending for property purchases increased by 1.6% in March. Obviously, a lot more still to owner-occupiers than for investment purposes, but it's now getting back to that sort of decade-long average in terms of being around 35% for investment lending. As we can see here, owner-occupier lending's far larger as a share. Then something that we see a lot of commentary about in the news is this level of debt-to-income ratios. So this is, again, the regulators looking at people needing to be able to service their loans in a robust manner as interest rates increase. And we all know that the banks actually set their benchmark rate far higher than the official rate has been, and the banks have been looking at serviceability components at 5.25%. That was brought in on the 1st of November when they increased that from 5%. So there's quite a lot of buffer involved already. If I look at other things like loans that are interest only, again, they're not particularly high. Looking at history, debt to income ratio of greater than 6. This number keeps popping up. That's increased, so I think that's something to look at. And the banks are actually now starting to come out with some internal measures to try and combat that. The other thing that I look at is loans originated with a loan to value ratio, LVR, above 90%. Again, that's diminished. So that to me, again, reduces risk. And I think the Australian financial system is pretty stable and very robust. As I said, investor finance has increased to just over 35%. And you can see there's been pretty sharp increases in virtually all the states there. So it's across the board. And I think that will probably continue as people look to diversify into growth assets that are giving them a reasonable yield with perhaps less volatility than mark-to-market assets. So on that note, if we look at property as an asset class in Australia, it's the largest asset class in the country, and therefore the RBA and government and Treasury all have to be very careful about what they do with this. So the rate of growth has slowed right across the country, but we need to look at the various markets, and that means all the capital city markets and the major regional markets around the country, because they're all going through a different part in their own microeconomic situation. For the quarter, overall values went up 2.4%, bringing it down to an annual increase of 18.2%. But let's have a look at both which markets showed variation and also which sectors of the market, so becoming more granular, showed the most variation. On an overall basis, if you look at Australia, this is more important, I suppose, when we're talking to expats around the world or people living in other countries. You can see that Australia is right there in the middle of the pack. So property in Australia is not as expensive as a whole as some people might think. Certainly areas like Sydney, it is getting very much into affordability constraints again, which will be exacerbated by increases in the interest rates. If we have a look at the NAB, National Bank's forecasts, we can see next year they're anticipating 11.4% decline in Sydney and Melbourne, average of 9.3 overall. And as you can see, the smaller capitals are going to fare far better out of that, according to NAB. One of the interesting things that I put up there is that price decline of over 5% in a year nationally is pretty rare, and it's only occurred less than 5 times since I've been keeping data in Australia. So something to bear in mind, and I'll come back to that later. This is the latest from Westpac. They've actually changed their forecasts on where they see housing prices heading, and as you can see, the forecast to the end of 24 there in red, you see the biggest declines in Sydney and Melbourne, which I agree with, because they are the markets, let's face it, that moved the most during the last 2 years, had the greatest degree of price appreciation. And the smaller capitals, it's Brisbane is probably the standout there. I think Adelaide also is showing a lot of those tendencies, and Perth, starting to see a little pickup. We'll come to more granular data a little later. This is from ANZ, so similar there. If you see, Brisbane, Adelaide, Hobart showing great growth last year, but then again this year, Brisbane and Adelaide being the standouts, and in terms of declines next year, not as large as the major capitals, however still significant. We'll come back again to what we think about that. If you look at the quarterly dwelling value increases, I'd said 2.4% on average, but that ranged from 0.1% in Sydney to 6.4% in Brisbane. And these slowing growth rates are evident across, as I said, all capital city markets except Perth and Darwin, and they're coming from a different base. We'll go through that in detail. Now, if we look at this in a more, as I say, granular basis, then Melbourne and Sydney saw the weakest dwelling value growth across all value segments, and Brisbane and Adelaide the reverse of this. But if you have a look, the top quartile there in Sydney and Melbourne actually showed negative growth, and I think that'll continue, and that'll then spread right across the board more quickly in those markets than in the others. Very important, supply and demand, as we always know. you know, again, this is really getting some headwinds from supply bottlenecks. So total dwelling approvals saw a pretty sharp drop of 18.5% through March, and that was driven by a virtually 38% decline in unit approvals. The other thing we're seeing is approvals are still coming through. However, I wonder about the actual completion of some of these projects, because there are some significant headwinds due to increased input costs from materials and also labour, and being able to get people to actually complete this construction. So I think, you know, we'll see some more pressure on supply, unfortunately, over the next 12 to 18 months, and that'll have an impact. So the other side of that equation is, how much income am I getting on my assets? So if we look at national gross rental yields, they've posted their first increase since August 2020, and that's because rental growth has exceeded property value growth. They act inversely. So it's not that people are getting less rent, they're actually getting more rent, but as a yield, it's changed, and I think that will continue also. Again, very different in different markets. And we can see there, you know, the yield in Sydney at the moment is 2.5%, the yield in Darwin is 6%, and regional areas are yielding far higher values again. So if we look at rental yields and then rental values, look at a nominal basis, as you can see there, median rent for houses in Sydney, if you look at the most expensive versus the most affordable suburbs, there's a massive gap. You know, Sydney, $2,308 a week as opposed to $404. And that's playing out in other markets as well. So as capital values decline, I don't anticipate the actual nominal rents to decline. I expect them to increase, so that's going to impact on yields. So how do we utilise the research? Because there is so much information out there in the marketplace that you need to try and make sense of that. So residential wealth, as I said, it's the largest asset class in Australia, almost $10 trillion. The interesting thing to note there too, because a lot of people speak about the level of indebtedness, if you have a look, the outstanding mortgage debt against that is $2 trillion. So when you look at that in context, it's actually not as alarming as people think, because most people take out an 80% LVR mortgage to buy their property, so everyone thinks that they're in the same boat, but they're not. Many people have properties that are not leveraged at all. So let's look at what's happened to house prices and the performance during tightening cycles in the past, because, you know, I always look at history. Okay, it's not a prediction of what's going to happen in the future, but I think most people do look at history and see what's happened in the past. And as we can see there, you know, especially now, because we're coming from a period of very low interest rates, so these increases in rates are going to be a headwind, and certainly from central banks' viewpoint, they hope so, because they're trying to dampen consumer demand by moving rates up. And if this is the case, then they don't have to move rates up as much if the consumer stops spending along the way. But if you can see, during previous tightening cycles, you know, house prices rose in some instances fairly significantly. If you look at the gradual tightening cycle between 2002 and 2008, you know, prices rose 50%. So a bit early to have a look at that, but I'll sort of hark back to this later when we looked at it at the beginning of the pandemic, because housing is not a speculative asset as such. So people need to live in these homes, and that'll have an impact on many factors regarding how prices are going to play out over a period of time. And people always say to me, oh, what's happening in the Aussie property market? As many of you will know, I say, well, there is no Aussie property market, because there are really 25 major markets around Australia, so the 8 capital city markets and then the major regional markets. And they're all behaving differently at the same time, like now. The important things, I suppose, that we look for, and there are 3 major ones: you need to have population growth, you need to have existing infrastructure and infrastructure growth and employment growth. They're the three main, I think, key characteristics to make the outcome of investing in residential property as easy as pie, and that's what the pie stands for, obviously. So let's look at that, and let's look at the various markets. Firstly, the capital city markets. If we look at New South Wales, it has the most diversified economy in Australia. It has seen now the first quarterly house price decline, and there are further downside risks, obviously, and that's due to affordability and the actual nominal price of properties in Sydney. So I see that market and Melbourne being, I suppose, more at risk in relation to rises in the official cash rate. However, there's an ongoing strong demand for quality properties there, and evidence on the ground. We still see that quality properties are commanding very significant and robust prices, and I think that will also continue. So if you look at Sydney there, if you look at the quarterly change, you can see here on the right side of the graph that decline, that's going to continue. Prices are now 0.3% below the previous record high, which was set in January, and I think they'll continue in an orderly fashion. If we look at Melbourne, that's got some other issues. It has negative population growth issues which are still persisting, and a lot of that is due to interstate migration. I'll come to that later in this review. There are still some post-COVID lockdown impacts where Melbourne suffered one of the longest lockdowns in the world at 270 plus days, and that's still working its way through areas of the local economy. Negative quarterly growth again, I think that will also be orderly, but there in Melbourne particularly, the loss of overseas students had a much larger impact because it was the biggest beneficiary as a city in Australia in relation to I guess recruiting and bringing in overseas students. So it had a bad impact. I think that will reverse. So if you look at Melbourne, they're a bit like Sydney, and on a quarterly basis, you look at the change, you look at the annual change. Melbourne house prices are only just 0.1% below their peak set in February. But as you can see there, over the past year, they've increased only 9.8%. If you look at Perth, it's actually been better this just the last month, last quarter, I think. Perth has been the net beneficiary through the pandemic of very stable employment based on the commodity industries. The lack of diversification has been a big positive, I think, for the WA economy. Very low vacancy rates in properties, although vacancy rates are very low right across Australia and continue to trend lower, and it's something that we should bear in mind. So rate of price growth uptick there just in this, as you can see on the right, you can see on a quarterly basis that uptick, which is pleasing to see for Perth. As you can see over the past year, increase has been more modest at 7%, and dwelling values are still just 0.2% below their record high, which was recorded 8 years ago. So it's a bit like Darwin. Both of those capitals dealing more with, I suppose, what happened during the mining boom. So this is a question that we often receive. Should I buy an old property or new property? Well, they both have very good attributes depending on your situation. Most of our certainly expat clients and our professionals in Australia, a new property suits them better because there are no repairs and no maintenance to worry about due to builders' warranties. You tend to get better tenants, and it's easier to rent and manage those properties. So people they prefer a no-touch, but we call a light-touch outcome. But with an old property, you could add value, especially if, say, you had some experience in the building industry and you have the time to be able to do that. Probably very difficult currently because obtaining tradespeople and builders and labour to do these projects is very hard at the moment, and also very expensive. So, but under normal circumstances, certainly you can add value on that basis. The other thing that exists in Australia, major tax benefits due to Division 43 and Division 40 depreciation allowances, which can have a fairly significant impact in relation to the actual tax that you pay on rent or eventually when you sell that investment if you choose to. Now we're going to have a look at the different regions and see which ones are best positioned at the moment in this economic cycle, which is, let's face it, we're now going into this rising rate environment. So it's pivoting and it's very different. Let's look at what the data is telling us. With this investment cycle, remember the easiest pie: population growth, infrastructure growth and employment growth. So what the data is telling us is that Brisbane is probably the standout market. I think it's been that for a while, and it's more so now. Queensland has a diversified economy, certainly has, and we've seen this coming through already prior to the pandemic, the lifestyle factor. So people are moving interstate, particularly from Melbourne and from Sydney, and moving to southeast Queensland for lifestyle, and I think that's going to continue. There's now an even more substantial value gap. So we've spoken about this for a number of years, where a property in Sydney might have been $2 million and was $1 million in Brisbane. Well, now the property in Sydney is $3 million, and the percentage might be the same. It's 1.5 in Brisbane, but in real terms, in nominal number terms, that gap's even greater, because it used to be $1 million and it's now 1.5. So I think that's something that people need to bear in mind, and the market is certainly picking up on this. And this ongoing interstate migration is the strongest in over 15 years, and that's where Melbourne is suffering in particular, but also Sydney, and the net beneficiary is southeast Queensland, Brisbane being the capital. So if we have a look at this here, again, in terms of quarterly and annual change, you can see over the last year Brisbane is up 29% and 6.4% over the quarter. You can see, that's pretty strong. That's pretty robust. And all of the figures we see from evidence on the ground suggests that that's going to continue, certainly for the rest of this year. And I think next year, if we have a price decline, it'll be fairly modest in Brisbane. So if we look at this, some of the drivers, the easiest pie, population growth. If you have a look at the change in population for Queensland, 1.1% over the previous year, clearly driven massively by interstate migration. And Victoria, if you see that minus 33% basically, that's having that outflow, and that's continuing. So I think potentially for Melbourne, if we get skilled labour coming in as well as students and short-term visa holders, that could make up some of that gap. So we'll be keeping an eye on these numbers as they come in on a quarterly basis and share them with our viewers. But if you have a look at that on a graphical situation, a natural increase, the lighter blue bars, net interstate migration, the dark blue bars, again you can see that interstate migration into Queensland, out of New South Wales and Victoria. And then if you have a look at net overseas migration, again very negative in Victoria, slightly positive in New South Wales, and as you can see, slightly negative in the other capitals. But it's the interstate migration that's really causing that shift, and I think is set to continue. I've been watching this for the last 8 or 9 quarters, and then this is just continuing to grow. So as we've said before, we see a repeat potentially of what happened during the last cycle when properties moved up, or when property prices moved up in Queensland as opposed to, say, Sydney and Melbourne. And I think we're seeing a repeat of that. We now have other tailwinds such as the Olympics, which I'll speak about a little later. That'll continue that, I think, in the long term. So if you look at that, we all know that Brisbane has won the right to host the 2032 Olympics, and although that's 10 years away, we look at what happened in other capitals that hosted the Olympics. There's this long-term build-up of infrastructure, and a lot of that began before the pandemic, then was spurred on by fiscal stimulus by the government during the pandemic and is going to continue. So we really look at it again with a bit more granularity and say, well, where is that going to play out most? So that's for another session because there's a lot to be involved in that. But there are certain areas which will obviously pick up perhaps even greater tailwinds than others. But the region as a whole, I think, will continue to thrive from this. There'll be ongoing employment opportunities being created, both new and ongoing, and clearly an increase in productivity due to many of these infrastructure projects that are going to be built. So if we look at the infrastructure growth, again, a lot of this was started before the pandemic and is coming to fruition as we speak. The parallel runway at the airport was completed last year. That actually gives that airport the throughput capacity of Changi in Singapore or Hong Kong. Didn't have much of an impact clearly when the international borders were shut, but now will come to not just be a major employment hub within Brisbane, but be able to bring through that through flow of international visitors, and I think that's going to be a pretty major tailwind. There are many there. The Cross River Rail. I can go through all of these infrastructure developments that are already underway, just been completed or just been approved, and we can go through that with people on an individual basis. If you have a look, then what is, I guess, our value proposition to people? How do we help? Well, we try and help people, I guess, not make some of the common mistakes that people often make. Instead of buying into a market that's peaking as a strong market, we like to have people buy into a strong market of the future. And that's why we've said, we've actually thought that Southeast Queensland is a strong market of the future over the last number of years, and that is playing out as we thought. Waiting too long to invest, and this is quite often a function of too much information rather than lack of information and research that's available so broadly these days on the internet. And it's something that, as I said, we need to try and make sense of all of the numbers, use your practical experience a lot of the time, which has generally cost people money, to make the right decisions there, rather than just being paralysed by trying to digest data. Ignoring your point of difference, I think, is another common mistake that most people make. So they might buy a property asset based simply on price, or other areas that don't add to its long-term capital growth appeal, and that's where points of difference will really come to play. So buy quality assets in sought-after areas, and any investment certainly won't do. A lot of people get lazy, so I've been meaning to do this for years, and I just want to do it now. But if you have a look at some of these sort of examples there, one of the things that we find is that Australians tend to want to live in more, especially this right sizer market, we call it, so people downsizing or upsizing, right sizing, they want to live in dwellings that are built for owner occupiers, so boutique dwellings that are generally larger, oversized, higher quality, not the buildings that have hundreds or 1,000 apartments in them, where many of those are small one-bedroom apartments or ones with challenged floor plates that are simply designed to be sold into the investor market. Or the other issue that we've seen is where you've had people buying into I call them single theme economy markets, and I look at Port Hedland because I know that I lived there when I was a child. It may be going well at certain points in time in the cycle, but other times you really tend to suffer in terms of being able to liquidate those assets or even gain an income from them. So these are important things, and they're sold on high yields, etc. So it looks all good and glossy on the surface, but won't give you your long-term outcome that you should try and achieve. So looking at that further diminishing supply, as I said at the beginning, I think the headwinds that are being created at the moment due to rising construction costs and lack of labour to complete these projects is going to do exactly this. So supply of the right style of quality assets is going to continue to diminish, and demand is actually increasing. So that's going to create an imbalance. This is a survey of home buyer preferences that the ANZ did recently, and if you have a look at that, you know, what builders noticed was the preference for working from home spaces. And I think most of us would know that a work from home room space is certainly a beneficial thing when you actually A, have to work from home, or B, choose to. But otherwise, as I say to people, if they are going to buy a medium density dwelling, an apartment, buy a 3-bedroom one, or a 2-bedroom with a you know, work from home space. Buy larger properties, because that's really what people want, and I think will continue to want. So putting it all together, let's have a look at, you know, what we think you should do. People should buy, as I said, into those areas with a pie. You know, population growth, infrastructure growth, and employment growth, strong economic activity. Make sure you buy quality assets in sought after locations, so they're your unique attributes of your property, and make sure that that's sustainable in a long term, not just in a particular part of the economic cycle. So what are the opportunities? Well, these are just some examples that we look at. You know, as I said, boutique dwellings in these sought after locations. That's what people are looking for. Larger floor plates, because a lot of the right sizer market, people are actually coming from homes. They want to stay in the suburb that they're used to. So they want a bigger living space, and they want areas to entertain or have their children and grandchildren come and visit and stay with them. Modern luxury townhomes, again, something that's difficult to find in the right suburbs, in the right areas, but that's something that people look for, and I think will continue to. We call these infill locations, so in the capital city markets, you can come across these situations where you can find some land where builders can develop more, you know, higher quality luxury homes in what we call that inner the middle ring, so 3 to 13 kilometres from the CBD of a city. The coastal markets have been, the lifestyle markets I call them, have been very strong beneficiaries of the trend of work from home, particularly in southeast Queensland, so the Gold Coast and the Sunshine Coast. Boutique dwellings with high quality amenities. They're the things that people look for. So if you have a look at, you know, other areas, and I think it's pretty important, people need to understand that you need to look at investments on a quantitative basis. So rather than saying, gee, I hope that goes well, you know, let's have a look at all of the costs of acquisition and then the ongoing costs of ownership, of keeping those assets. So it's important that we look at what those numbers should look like. If you look at this has been, you know, the outcome over most cycles over many, many years in Australia. This is for Australian tax residents, and that's what the pies looked like. You know, the tenants paid most of it, the tax office a large portion of it, as I say, because of depreciation allowances, and the owner a very small part of the pie. For expats, that's actually a little different, and especially where interest rates are at the moment. It's mainly the tenant, and the owner is paying a very small component of that on current interest rates. Most of our owners actually paying nothing because they've been fixed into longer term rates that we did last year. So have a look at this, because really at the end of the day, you know, why do you buy an investment property? It's to increase your wealth over time. And people can often sort of be forced in a situation where they think that they might need to spin their wheels more than they should, because if you have a look at this, property is not a speculative asset. You know, you can't pick up the phone to your broker and say sell, you know, half that bedroom. So it's a lumpy asset. There are costs involved in buying and selling it. So it's something we say to our clients, well, keep it forever if you can, unless you've got a good reason to sell that particular asset. So Here we're just looking at numbers, and it's looking from the September quarter last year. The median hold period for resales across Australia was 8.8 years. And over that period, dwelling values increased a bit over 62%, which is great. However, if you actually then decided to not do anything and just keep that asset, and we have many clients in that situation, where you start getting to 20 years plus, as you can see, that's really where you're going to see all of those outsized increases to your net wealth. And the interesting thing is you don't have to do anything. You just have to be disciplined not to do anything. And it's harder than we might think. So we've been doing this for a long time, over 30 years in the various business models. We can supply a great deal of, value add to our clients, especially for, this is both for Australian resident clients and Australian expats. We can provide up to 85% loan-to-value ratio loans, LVR loans, with no mortgage insurance. So you don't have to pay mortgage insurance to protect the bank. That's very important, especially for younger clients who are starting to enter the market. It means they have to have far less cash in terms of deposit, or people who are trying to extend their current property portfolio. So that's really important. Looking at the tax situation on most of these things is also a very big feature that we help people with, and looking for these properties that do have a sustainable future with great points of difference that are going to differentiate yours from many other people's. If we have a look at that, we look at profiling things for people and assisting them with many parts, I suppose, of being able to make more informed, better decisions in terms of how they want to invest, where they want to invest, and what they want to invest in, or just assist them with, their own plan if they already have one. So they're important things. We've got a bit of a Q&A now, so let me just go to that. And let's have a look here. We'll might go through some of these questions that we've already got. Question from Samantha: what's the impact of interest rate rises and the new government? Potentially two separate questions, I think. So let's deal with the new government. I don't think that that's going to have a major impact on the Australian property markets around the country as such. Both parties had, tried to woo voters with provision of lower cost housing, etc. But I don't think it's going to have a major impact at this stage. We'll wait and see how that plays out, because it's going to be positioned, as a counterbalance to what's actually happening with these rising interest rates. Now, that's obviously going to be a headwind for property prices, and I think will be felt, as I said, over the next 18 months to the largest extent in the markets in Sydney and Melbourne, because they're the ones that have been going up the most. So you're going to have more affordability issues in those markets. I think it's going to happen in a very orderly manner, and I've seen lots of stories in the news in terms of potentially those markets losing 25% of their value after the first 100 basis point increase to interest rates. I actually don't see that happening. I think that there's not going to be a wholesale need for people to sell their homes. As I said, they've all had their borrowing capacity, serviceability ratio already broken down on the ability to pay interest rates at 5% or 5.25%, depending on when they took out those loans. So I don't see that. I think it's going to be orderly. I think Sydney may definitely, and Melbourne have a decline of 10% in the market over the next 18 months or 2 years. But I don't see that being a national impact, and I think on a national basis that property prices will potentially not come down much more than 5%, as we've seen in the past when we've had these rate rise cycles coming in. Okay, what else do we have? here. Right, okay. Ashley, you've got quite a few questions there. I'll come back to those. Let's start with, do you have any recommendations on the type of vehicle a non-resident might hold a property to avoid punitive non-resident tax rates? There are really no punitive non-resident tax rates. The Australian government keeps those for foreign individuals. So the best vehicle, the simplest one, is buying a property in your own right, in your own name. Actually, I'm happy to explain that to you in relation to how you might do that. In fact, if you become a little too intricate with some of these things, you could by default trigger some unwanted effects in terms of paying extra taxes on property acquisition or ongoing ownership by buying it through another legal vehicle, through a trust or a company, which wouldn't be ideal. Is there any commentary behind why Westpac thinks the Aussie dollar will strengthen to 80 cents? You've got 8 cents, but I'm guessing it's 80 cents. Well, I'll give you my impact on that, or my commentary on that, and I'm sure it's shared by Bill Evans anyway. Last time commodity prices were in the sort of area they are now, the Australian dollar was $1.10 against the US dollar. So, as I said, from a fundamental viewpoint, the Aussie dollar is actually quite undervalued against the US dollar, and if you look at it against a basket of other currencies, it's been fairly strong. As you've seen, it's strengthened against the euro, against pound sterling, so worth bearing that in mind. I think probably the biggest headwind to the currency going back to 80 against the US dollar will be the rate of increase by the Fed in their Fed funds rate. So how quickly and how far they're going to go, because I think they need to go quite a bit further than the Reserve Bank of Australia, and the markets aren't pricing that in. So that's going to be a headwind to the appreciation, and I think that is why they've pegged that to only increasing to 80 cents, because otherwise it could easily go to 90 cents, to be honest. That's only my opinion, but I think it's shared by quite a few economists around Australia, certainly. When you say, can you act as an agent for a sale for a non-resident, the Australian real estate business, yes, it is a real estate business, and it can act as an agent for non-resident or residents. So that's the answer to that one. What else have we got here? Right, let's just from someone else. Okay, that's a good question actually. Refinancing from a fixed principal and interest rate loan back to interest only. What are the break fees and other costs to break a short-term P&I loan? Why was the Westpac variable rate so high in Feb? And what documentation is required to refinance from abroad? So many questions from Jacqueline, London. Look, refinancing from a P&I loan back to an interest-only loan, you'll generally have to demonstrate that you can effectively service that loan again. So it's a new loan application. There are break fees if you have a fixed rate interest rate loan in place. I dare say at this stage it wouldn't be, it'd be less than nil, because your current rate will tend to be lower than the rate now. So if anyone's been looking, and this has gone on for all the banks, we get emails from the various banks, and we deal with 30 plus of them, every few days about interest rates, their fixed rates increasing. So fixed rates have gone up massively during the course of this year. Why was the Westpac variable rate so high in Feb? It was the same as all the other major banks. The current, if you like, headline rate of all the banks is close to, between 5.5% and 6.5%. But then all borrowers will tend to get a discount on that, and that's the effective rate they'll be paying. documentation requirements for refinance from abroad, they're very similar to a refinance for any of our domestic Australian clients. And again, something we can go through with anyone on an individual basis. You need to show what your income is, what your asset and liability position is, and what your expenses are effectively. Documentation required are the supporting documents that you've based that on, I suppose. So let me just have a look here now. Thanks, Gary, I appreciate that. Okay, anyone else have any questions? Please fire away. No? Don't have anyone there that's wanting to ask us anything else? Ricky, Matt, Amber. All right, well, if everyone's happy with the answers there, please, if you need anything else, you can always follow our Q&A sessions, which we do on a weekly basis. Subscribe to our YouTube channel and click like if you like the information that you're seeing, and then reach out to us via email or call if you need to discuss anything on a personal nature, and we'll send you a feedback form if you'd be kind enough to fill that out, because that certainly helps us in terms of future presentations and looking at ways to present data that is most sought after by all of our viewer base around the world. So the feedback form has gone out. Please, if you can get that back to us, it'd be awesome. I'll see you at our next quarterly review. All the very best.